So yeah, I think we stop here, isn't it? Okay, so I just briefly, I think this example is important. Okay, I will be the um, one who's gonna prepare questions from this chapter. So this is my part. Okay, so which one? Besar. Oh ni, dah lama tak mengajar. Okay, okay. So if you look at here that I think in the previous class we already give lecture, okay, and some examples how to solve these problems on the economic evaluation for air purifier products, right? So number of units is annual sales lah. So if you look at here that 50,000 unit, okay, and the price is $300 per unit. Annual advertising budget is 2.4 millions, right? Manufacturing equipment cost is 3 millions here. What else? Uh, Development time is 1 year. Okay, development time is 1 year, and then development cost is 2 million. All right. NWC net working capital is 2 million, and then fixed cost 1.5 million. Variable cost $80 per unit, right? Um, so this one we have to times with the number of units lah, so that we can get the actual variable cost lah. So this is per unit lah, right? And what else? Bank interest rate is 5%, right? So this one we have to compare with the IRRs later, whether it's lower or higher than this 5%, so that we can consider whether you can undertake this project. Okay, and then the tax rate is 40%. Okay. Based on the MACRS 5 years, so you have to do the projections about 3 years. So what you have to do is you have to construct the book value lah. Okay, this is the summary. Nice. So for the summary, annual sales 50,000 and so on. Okay. So the equipment cost after 3 years, if you look at here, that is equal to zero, no value, is a nil. Yeah. So we have to calculate. Okay. So what you have to do is you have to construct the book value. You have to calculate book value. Okay, is the original price minus with the total amount of depreciation or D lah. Okay, this one. So look at it with by 3 years of MACRS. Okay, so just take this value from the table 17 point, if I remember 17.9. Okay, and then time with this one is 3 million manufacturing equipment cost, isn't it? Okay. So you can get the depreciations lah. Okay, this one. Okay. So and then you have to determine the book value. So meaning that 3,000 minus 600, you can get 2,500, and 2,000 minus with 690, you can get 1.40 and 894 and so on. Okay. So this is important for the calculation of the NPV and also IRR. Okay. And then after you determine the book value, this is the table 17.9 and ACRS take basis depreciation. So we just take these 3 years. Okay, if we extend to 5 years, so you have to calculate 5. If you extend until 7 years, so you have to use this one. Okay, okay. What you have to do is a construct table based on the sales, fixed cost, variable cost, IFO, D, EBIT, tax, ATOI, OCF, NWC, capital spending, and PCF. Actually, there's another rule for the equipment cost after equipment sales, right? After 3 years or 4 years, okay. After certain after the projection, okay. But for now is the equipment sales. We have defined that is equal to zero, so that's why there's a no rows or the column for the equipment sales after this, because we assume that is equal to zero, so there's a um no value. But once you make a make or buy decision, we have to consider that this equipment sale after maybe after 3 years, 4 years, okay, there is a value lah. Later we will see in terms of when we make a comparison between make and buy scenarios lah. Yeah. In terms of sales is constant, okay, every year, okay. And then variable cost is 2 million, right? Variable cost is a development cost, this one. Fixed cost is 4,000, right? Because this is including annual advertising and also times with the fixed cost, this one, look at it, right? So advertising we consider as a fixed cost, and this one, so you can get 4 million. Okay, the same for every year, right? Okay. And then variable cost. If you still remember that variable cost is $80. Okay, $80 per unit. So we have 2 times with the 50,000 units. Okay, so we can get 4,000. So this is the value in thousand. Okay, so meaning that 4 million. Okay, and IFO. So based on how to calculate this IFO differentials, we get from the book value. This one, okay. Just refer back to the previous equation. This one. If you still remember. This one. Okay. So IFO, EBIT, and this one is tax, right? OCF. Okay. So just use this equation and put in the use for the calculation and put in the table. Okay. So depreciations 600, right? In the value, this one 7,000 So meaning that 15,000 minus with the 4,000, 4,000, 7,000. Because sales minus with the CED, right? This is a CED lah. If you still remember. Okay, so you can get IFO. Okay. Then EBIT and so on. Tax. This one are times with the 40%. Okay, 6,400 times with 0.4 lah. Okay. So do for all yes. Okay. So if you look at here that the NWC is 2 million, and we inject for the development cost, right? The manufacturing equipment cost is 3,000. So meaning that this one is still this is variables. Okay, the first money that you use. Okay, this is the investment lah, the money that you invest, that you inject, right? So total is 7,000. Okay, 7 million lah, 7,000. Okay, 7,000 times 1,000. Okay, and then this one, you just bring it down here. This one down here. This one together. Okay, 4,430 plus with 2,000, so you can get 6,430. Okay, so amount of the money that injected is 7,000. Okay, and then we have to calculate the what is it? We have to calculate NPV, isn't it? Okay, so how to calculate based on the NPV equations? Okay, 2,000. This one is J below than 1, J equal to 0. This one J more than 0 lah. Okay, J is equal to more than 1. Okay, just refer to this here. Sorry, below. Okay. Okay, J equal to 0, J equal to 0, J more than the 0. Okay, this one. So you can get 3,204. So this is positive. So meaning that your project is we can continue. Okay. So in terms of IRRs, okay, NPV is equal to 0. Okay. So just using the rearrange these equations, okay, and using the interpolations or solver in using the Excel, so you can get this value of R. Okay, so R, this one is a 20%, but this one we have to find the value of R. Okay, so if you look at here, that 40.43%, and when we compare with the bank interest is 5%. So meaning that we can continue. If lower, we cannot. Okay, 5%, we cannot continue this project. Okay. Okay. So if you look at here that this one's okay, 2 millions. This is 2 millions for the first year. Okay, times with the 5 million. So total is 7 years. 7 million. Right. Okay. And then so you can get a positive value after 1 year. Yeah. Okay, this is your profit. Okay. So ni balik modal lah. Okay, after 1 year, 1.5 years, so you can get the profit. Okay, I think you have learned in what is it? Economics, engineering economics. Okay, so take the one piece of paper. If you look at here that you have to do this tutorial. A company is considering a new 3 years expansion project that requires an initial fixed investment of 1.8 million. Okay, the fixed asset is the depreciated based on the 5 years class MACRS. So after 3 years, the salvage value is assumed to zero. So the equipment, meaning that no value for the equipment. Yeah. And then what else? The project is estimated to generate 1.85 million in annual sales. Okay, cost 0.65 per year on the cost. So tax rate is 40%. What is the operating cash flow? So meaning that you have to calculate until here. Can you do? You have to determine this one. Okay, can you do? So first you have to what you have to do is you have to construct the table of book value. So in terms of book value, look at here that ini ada ni tak? Pen presenter pointer. Okay, pen. Pen I think. Okay. So year lah. Have to do year 1, 2, 3 lah. Okay. So MACRS. Okay. CRS 3 years 20, 32. And then this one 90.2. So what is it? 1.8, right? 1.8, 1,800 fixed investment. So this is time 1,000. So I just 1,800. Okay. Can we do together? Okay, take 1%. 1,800. 1,800. 1,800. Okay. So and then depreciation. So times lah. This one 1,800 times with 0.2. So when you have times, so you can get the value here. Okay, and then book value. Okay, book value times 1,000. 1,000. Okay. So once you get this one times sorry 1,800 minus with depreciation. Okay. So you can get this one. Okay. So you can do how much you can get this one? Book value. Okay. So we have to do together. Okay, because this will be your assignment later. Okay. Okay. Done. Okay. So you can get 1,800 times with the depreciation. Okay, and then the rest you can follow the previous example. Okay. Anyone can get this one? One value, this one value. Okay, maybe for your finals, you can what is it? Prepare with the tables, okay, for easy question. But you have to handwriting for your answer. Do not copy from your Excel. Okay. So you have to rewrite for your finals. Calculation can you can use Excel file. Okay, done. Okay. So I just give a flow lah. This one. Okay, next, what you have to do is I have to erase this one first. Pointer, erase all link on slide. Okay. Okay. And that's what you have to do similarly. Look at here. You do after you construct this table, right? This table, you do this table starting from -1 lah, because your investment, your what is it? Is one within 1 year, right? Okay. So we will assume starting the first year lah, before you start the what is it? The manufacturing. Okay. So and then similarly, okay, what you have to do is the year. Komputer ni tak boleh. And just use this one. Okay. One. Right. Okay. And then so lah. This one is year. And then sales. What else? Annual cost. This one annual cost. Okay. What else? IFO. The same. Okay. Precisions. EBIT. What else? Tax. 40%, right? What tax is 40%? Atau OCF. Table bawah. Okay. Then -1, 0, 1, 2, 3 lah. Okay. So this is 0, 0 lah. There's a no, what is it? No C, right? Okay. And then this one lah. What else? Project 185. Okay, meaning that the sales are 185. 185. 0 lah. 1850. 1850. So this is time 1000. Okay. What else? Annual cost. What is the annual cost? 650. This one, annual cost. Okay, because annual sales and the cost is 150. Okay. And so on. IFO. So minus this one. So it's the negative. So 1850 minus 650, 1200. Okay, the depreciations from the table from the book value. So you can put here. Okay, EBIT. Okay, then tax. Uh, this one you have to refer the previous. What is it? EBIT is equal to what is the equations? Okay, IFO minus with depreciation. So meaning that this one. So you can get EBIT. And then once you get the EBITs, you have to calculate tax lah. So times with 40%. Okay. So you can get EBIT, this one EBIT times with 40%. So you can get this value. Atoy. So 1 minus T. X darab dengan EBIT. So you can get this one. So OCF. OCF Atoy plus D lah. So you can get OCF. Okay. So please calculate the final OCF for every year. It's going to be different. Give me the value for first year, second year, and third year OCF. Anyone can give me the value? I just pick one name, so please give me the value, okay? So I give you about 5 minutes. What's the final OCF? First year, second year, and third year. Okay, anyone? Answer? No answer? Amira? Amira? Amira Jamal? Are you there, Amira? Sata? Sata Rob ni eh? Any answer Sata Rob ni? 864. Okay. Yes, right. Okay, for year one. Okay. For year one, 864. Eight, five, eight, two. This one is which year? First year. Okay. Okay lah. First year. And you can do for the next year, okay? So please calculate. Okay. So let's we continue. Okay. Okay, calculate the net present value, NPV and IRR in example 1. This one is example 19.1 in the main textbooks. If the product life cycle is extended from 3 to 5 years, all other input data remain unchanged. Okay, can you extend this one? This one is until 3 years. How about if you extend to the 5 years? Okay, so if you extend to the 5 years, so your book value also will be extended. Okay, from 3 to 5. So meaning that this one you use until this one for the calculation. Okay, so you have to include 11.52 for both for year 4 and year 5. Okay. Okay. On the fourth years, okay, on the fourth years, okay, just this one, meaning that 3,000 times with 0.1152, and on the fifth years, 3,000 times with 0.11552 similarly. Okay, and book value we're gonna see is gonna be changes. Okay, so change also. Okay, and for the fourth years and fifth year, you have to calculate. I think if you look at here, uh, for the this one is will be the same. Okay, for the fourth and fifth year, it's going to be the same. Okay, this one is going to be the same. Okay, this maybe is a 4 and 5, year 4 and 5. But the difference is going to be different. Depreciations. Okay, and bit also will be changed. Okay, since it's a change in the D, right? Okay, tax also will be changes. Okay, will be changed. Okay, and then the similarly, this one. Okay, the value of 2000s will be moved to year 5, not here. Okay, this will be blank lah. Alamak. Will be blank lah. Okay, sorry. Coming. Masuk. Kejap Kenapa? Ah? Ah, okay. So far kita nak sampai? Tak ada. Ha? Tak ada sampai lagi. Kerusi. Kerusi lah, kerusi. Ah, okay. Okay, okay. Okay. Okay, sorry. Mana tadi? Okay, this one. Year 4 and year 5. Next. So this is the same. This one is going to be changed. This is going to be blank. So 2000 is here. So this is will be changed. Okay. So amount of the money injected is going to be the same, right? This one is going to be the same. What else? So you have to calculate the NPV lah. So can you calculate NPV if for 3 years until this one, right? So NPV this one. So you have to add lah. Plus. Okay. So this one is not 6430, but this one is because without 2000, right? So without 2000, this one is 4430 lah. Okay. And add more. Okay. This one year 3. See, this one year 3. Then 1 plus R. Year 4. Right. Plus this one divided by 1 plus R year 5. Okay. So you can calculate, you can get NPV. Okay. So you can get IRR, just make it 0. So if you look at here, is it the project can be continued or not? So it's depending on the value lah, whether positive or negative, and also comparing with the bank interest rate, whether you can borrow the money or you just keep on it in the banks. So it's depending. If higher than bank interest rate 5%, so you can continue this project. If lower you cannot borrow the money. Okay. Okay. So any question about this example tutorial two? Any questions? Any questions? Okay, I guess no questions. Okay, so it's clear. So let's we move to the make or buy decision. Okay. So let's we. I think there's one question. No, that okay. So let's we move to the make or buy decision. Okay. We break for 5 minutes. Okay, if you want to go for drinks. Okay, kita rehat jap 5 minit. Okay. 10:50 we continue. Okay. For those who want to go to toilet, okay, you can go for 5 minutes before we continue for the make and buy decision. So we will finish by today. Okay. See you again in 5 minutes. Okay. Let's we continue. I hope that you can hear my voice clearly. Okay. So we continue on the make or buy decisions. Okay. For this one is also important. Whether you want to outsourcing your ingredients or you want to make in-house. Okay. So actually the chemical product is made out of many components or key ingredients. Okay. So often that companies buy some component from the supplier or the contractor. Okay. And sometimes they make in-house. Okay. You is depending on the what is it, the decision of the top management is also we can compare later with the IRR. Okay. Between make decision also with the make decision or buy decision. Okay. For this part actually we will study we will discuss how decision is made. and what is the other factors that for the product developments. Okay, there's a social factor, company factors. That one I think is just a general information and you can read. So I just explain briefly. Okay. So in the textbooks, okay, in the textbooks, I think you can read from the page 570, 570. That is all about the make or buy decisions. Okay, okay. Uh, for your information that all the manufacturer, okay, any products, right, and the manufacturer of any products, okay, they will begin with the key ingredient or the chemical precursor, okay, that maybe they can bought from the other companies lah to reduce the cost, right? Okay. For example, the company like to produce to what is it? Purchase a paraxylene, right? From an oil company. Okay. So they want to make a terephthalic acid lah. Okay. Together with the ethylene glycol. So maybe they can purchase from another supplier lah to make this polyethylene terephthalates. Okay. For another example, the air purifier, right? Like a previous example in chapter 5. Okay. So the company maybe can buy the HEPA filter, okay, or the catalyst PCO, okay, and also that one they can buy, but air purifying housing, so they can make, okay. So either you can buy or you can make in house, make by yourself, okay. So actually we can buy from different supplier, not only stick on one supplier, okay. Is this we cannot stick, okay. Later there's going to be resulting in the more price, okay. Maybe the price is going to be high, okay. So we cannot stick in one company lah, one supplier, okay. uh and then once you buy, okay, for the amplifier, okay, when you want to impregnate the catalyst in the filter, okay, all the assembling process you can do at the plant side, okay, you can do in-house, okay, and only the main ingredients you buy, okay. So if you look at here that make a buy decision, a strategic choice is often made between producing an item internally, okay, this is in-house, you make by yourself in your company, or buying it externally from an outside supplier. This is outsourcing, okay. So later we will see the factors that influencing the make or buy decisions. What is the situation that favoring to the mix, and what is the situation that favoring to buy or subcontracting lah, sourcing. Okay, for the item that are strategic in the nature should be produced internally, if at all possible. For example, if you look at here that item is critical to the success of the product, okay, including customer perception of important product attributes, okay. Second is maybe you need a special design, okay, and manufacturing skill. So this one you should produce internally, okay, because the number of capable and reliable supplier is very limited. Or maybe if you want to buy this, you want decide favoring to the buy this favoring what is it, you are the station is favoring to the buy, so meaning that you are not really capable, your company is not capable, but the other company is more capable, so that's why you favoring to the buy decisions, okay. And the third one, item fits well within the firm's core competencies, okay. There's no other company can fit with your what is it, your product development, okay. Outsourcing of non-strategic item may be economically attractive. Okay, meaning that if you compare IRR, if IRR for the outsourcing is higher than the internally or in-house, so we have to go to we have to decide for the outsourcing rather than we choose in-house. Okay, so we have to calculate IRR. We do the comparison, right? Okay, so this is the factor that influencing make or buy decisions and the heuristic for decision making lah. What is the situation favoring make and what the situation favoring buy or subcontracting. Okay, so if you look at here that if we consider the outsourcing of the manufacturing technology, right, process of vendor. If you look at here that this one. This one. Okay. So if you want outsourcing, okay. So the reason is we want to save the capital investment and also time lah, rather than you build your own manufacturing is gonna time consuming. Okay, and another reason maybe as I told you that the technology of the vendor or the contractor is much more superior. Okay, rather than your company lah. Okay, so if you look at here that February, right, the company has limited production experience. Okay, the supplier is more superior, and the supplier has better knowledge in the manufacturing technology. This one, okay, that's why you want to decide uh, to choose buy or constructing buy your ingredients or the chemicals. Okay, so when the product involve the propriety of formulations or the company on the manufacturing process or design that offer unique competitive advantage in the marketplace. So we are prefer on the process in-house. Okay. So if you look at here, that technology is newly developed in-house. No other company can produce or can supply your key ingredients. Okay. And also you are the leadership in the position for this product. Okay. So what you have to do? So you have to do in-house. Okay. Process in-house. Similarly, also for other factors like a resource, IP ownership, right? Okay. So all these things you have to consider for the make or buy decisions. And this one in terms of economic, quality, regulatory, and restriction strategic plans. So this one you can compare. So this one, if you look at page 570 is table 90.1. So this is important, okay, for your decision. Okay. So let's see the procedure for the make buy analysis of the product development. So this is the activity lah in the make or buy analysis. So we usually begin with the all make base case. Okay, and then we have a trigger by consideration. This one. Okay, which is if you look at here that uh, make base case, all manufacturing steps are performed internally. Okay, so this one you have to consider lah at this stage. You have to consider from the previous table. Okay, table 19.1. Okay, so you have to considering all the factors, the heuristic. Okay, to make by decision. This one. Okay, from the previous table. This one all the heuristic. Okay, so whether make or by decision we can do in parallel. Okay, we can do in parallel. Okay. So for B2C product, so there are many ingredients and also component that we can purchase. Okay, so we do the internals information here. Okay, so if yes, trigger by considerations. So we do the preliminary by action. This is we can see the ingredient list of the supplier, right? Okay, this is a by decision, and then we confirm by options. Okay. So if you look at here that we at this stage we collect from the various department of the company. Okay. Okay, and then the quotation vendor capability. This is the external information. Okay, and then at the same time you do the make option process design. Okay, and then you analyze both. Okay, generate manufacturing process with a different combination of make by step. So this one is a decision by the top management. Okay, when we do the comparisons. Okay, so concurrently we can do this make options. Okay, you can identify the design, the cost estimated to produce your ingredients. Okay, so and then you combine. So we can evaluate and score it option. Which one is the best? Okay, from the top management. Okay. So we do comparison especially if for these examples later we show the example we compare based on the IRR, but there's any other factors also. Okay. Okay. So this is the step. So we do in parallel concurrently. Okay. So if you look at here, this is the example to make and by decision. Actually, if from the textbook, this one is a 19.2. This one is 19.3. Okay. Recall the previous example, right? Recall the previous example. The marketing team now suggests a more realistic estimate of the sales volume and pricing strategies as follows, right? So unit sales 30,000, 70,000, year 1, year 2, and year 3. Okay, selling price is 300, 275, and 250. Okay, and you get the revenue after you selling this one, you get the revenue, this one. Okay, the management team want to compare two possibilities, make scenario and also by scenario, to accommodate the increased production in the second year. Okay, look at here, this is the second year. It's increased 70,000. Right. The engineering team recommend that the equipment cost increase from 3 million to 5 million. Okay, if you still remember the previous example, the equipment cost is 3 million. This one. This one. Equipment cost. Okay. Right. Okay. It is also known that the market value of the equipment after 3 years is 2.5 million. Previously, we assume as a nil or zero. There's no value for the equipment after 3 years, right? Okay, but now they have a 2.5 million. Okay. Okay, second scenario is a buy scenario. The additional 20,000 unit in year 2 are outsourced to a contract manufacturer. Meaning that this one, 20,000 times with how much? 110. So increase from 80 lah, by 30, right? So time 10 times 0. And then another 50,000. Okay, times with the normal price, the original price, $80 per unit, right? Okay, so meaning that 20,000 is outsourced at year 2, change in at year 2. Okay, per unit. The market value of 3 millions equipment after 3 years is 1.5 million. This one 2.5, this one 1.5. So we have to do comparison. Which situation is favoring the buy or make decisions? Okay, so we can see by comparing the IRR. Okay, so for this one, okay, for the scenario number 1, right? Okay, so what we have to do is manufacturing cost we increase from 3,000 to 5,000. So you have to calculate the depreciation as well as book value, right? This one, so you can get new value 1,000, 1,600, 900, 650, and the book value also changes. Okay, and this is mentioned that after 3 years, the market value of equipment is how much? If you look at here, 2,500, 2.5 million, right? So meaning that the selling of the equipment after 3 years, 2.5, 2,500 minus 1,440, this one, okay, minus, okay, times with 1 minus with the tax, this is a tax, 40%. So you can get 636. So after 3 years, this one, the equipment sales. See, this is the column, no, the row that I told you that you have to add, okay, before the PCF, between PCF and also capital spending, okay, this one, okay. The previously, this one is equal to 0, right? This one is 0, previous, okay, but now they have a value, $636, okay. Please remember this one in million, okay, right? And then advertisement cost is the same, right? Variable cost, the same, 5,600. Is it the same? Okay, look at here, 5,200. No, it's not the same. Okay, because variable cost is 80 dollar number of unit, meaning that number of unit you have to refer to this one lah, 30,000. Okay, not the same. Okay, 7,000, 50,000 for each year. Okay, meaning that it is times $80 times $80 times with the $80. Okay, can you see it's changed, right? Okay, and then IFO, and you calculate this one minus with this one, so you can get IFO. Depreciations from the book value, this one, right? Okay, and then EBIT, this one just minus. Tax time with the tax EBIT, Atau and all the information. So the injection, since the equipment cost, we increased from 3,000 to 5,000. So meaning that the money that we have to inject it is around 9,000, 9 million, sorry, 9 million, because in thousand, right? 9 million. Okay. And the rest you car. So if you look at here, so you add this one. 3,000 plus 2,000 plus 636, you can get 5720. So just based on the MPV, IRR, sorry, MPV is equal to 0. So we can calculate 20.05%. Okay. So this is for the uh, make decision. Okay, because in housing, okay, you just increase the equipment cost. Okay, and you want to make by yourself. Okay, in your company. How about the scenario B? Okay, this is a buy scenario. So if you look at here, variable cost in year 2, right? If you still remember year 2, $80 times with the 50,000 unit, because outsourcing only 20,000 unit. Okay, 10 times with the $110. So we can get 6.2 million. Okay, 6,200 lah. Okay, so 6.2 million. And in terms of book value, if you look at here that 3,000 minus 600, 690, 500, so we can get 864. Okay, the same as previous this one. Book value. This one. It's the same. Okay, it's the same. Only we change at the year 2. There's the outsourcing there. Right. Okay. What else? Oh, this is the same. Sorry, not the same. And the sale is 9,000. This one already changed. The change. Is it the same? Oh, is this the same? Okay. From the example one. This one the same, it's the same. This one is same. Only the difference at the variable cost. This one. You see this one? Right. This one from the first example is the same. This one is the same. Only this one is changed. Because there is an outsourcing here. Okay. Okay. And this one is the same from the example one. So you have to calculate all the things. So for the after tax money, if you look at here, it's 1.5 million. Okay, minus with 134, this one, the book value, times with 1 minus tax. So we can get 380. So we put here. 2,000 is here, right? So we just calculate this. The money injected is the same. Okay, 7 million. Okay, because we only change at the year 2 as an outsourcing. So the value is going to be different here. Okay, this one also is going to be is the same from the previous. This one is same. Only we change at the year 2, right? So if you look at here that the IRR 27.51%. Okay, so meaning that when we do the comparison, okay, make scenario and the buy scenario, IRR is much greater, the higher the percentage is much higher than the make scenario. So we choose as a buy scenario as a this one as our we favor on the buy scenario. Okay, so we outsourcing, we find the vendors or contractors, okay, to buy the key ingredients, our key ingredients. Okay, so this give the company the extra capacity, okay, flexible way, save upfront investment, result in higher return. Okay, so this is when we do the comparison. Okay, you understand? Okay, so if you do the outsourcing, please remember, don't stick with do not rely on the single supplier. Okay, if you want to purchase the ingredients, so resulting in the war price, or maybe failure risk related with the failure risk. Okay, and the economic bargaining of the single supplier can disrupt the production, increase on the product cost, right? Okay, cause a severe customer dissatisfaction. So do not rely on one single supplier. Okay, so please get the quotation from other companies, all the companies, and you have to compare the price. Okay, faham eh? Any question about this one, the comparison make and buy decisions? Okay, last example before we stop. I think for the factor, this one you can read. I just give a video. This one is just you can read. Okay, recall the previous example 19.1. The sale of air purifier seems to pick up slowly after product launching, but the product project team has big vision to seek a larger market share. Okay, through discussion with management and marketing team. The marketing team suggests new sale projection as shown in following table. Right. 50,000, 80,000, 60,000 unit sales. This one is actually in million. Okay, the revenue. And then selling price is 300, 265, 230. Okay, and the revenue is 50,000, 21,200, 13,800. Right? Okay. So this is the tutorial is similar like this one, I think. Make decision, make scenario. Is alright. Okay. Calculate the investor rate of return, IRR. Okay, thus the project can be continued. Equipment cost increase to 6 million. Okay, from 3 to 6 million. Okay, use 5 years MACRS. And the equipment after 3 years is 2 million. It's the same like this one. Mana? It's example. Right, only this one 6 million. This one is how much? 3 million. Right. Okay. This one is a 2 million. 2 million. Okay. And then you have to do the same. This one. Okay. Calculate the IR. Can you calculate? I give you 10 minutes. Follow this table. This one. You can change. I give you 10 minutes. Later I show you the flow. How much IRR you get? What is the IR? Okay, any answer? What's the answer? Okay. So if you look at here that the same, okay, 19, this one is an example one. Okay. So when you calculate this is the IRR and also NPV. Okay. And IRR about 40%. So you can get the profit after 1 year. Okay, the money of injected is about what is it? 7 million. 7.9 million. Okay. For the 203, if you look at here that what is change? The sales, okay, unit sales, 80,000. This one selling price and also depreciation also changes. Okay. So if you look at here that we have to make a new book value. Okay, because the equipment cost is already 6 million, isn't it? It's changed to the equipment cost is increased from 3 million to 6 million, right? So you have to calculate new depreciations, right? And then what else? New depreciations, and then book value also. Okay, if you look at here, this is 1728 lah. So previously it's only 800 something. Okay, and then you have to calculate the what is it based on the revenue, right? And this one is the sale exchange. The blue one is a exchange. Okay, fixed cost is the same. This one variable cost is changes, right? And then all these changes are based on the equation, right? And then this is a new rate is a negative. Put rate is a negative. Total this one is a negative 8,000. So total is the money injected is 10 million. Okay, changes. So since the equipment cost after three years is 2 million. So we have to calculate 2 million times with 728, right? Times with 104. So we can get 160 this one. So just add all this one. So we can get this one. So we have to calculate the book value there. The IRR. So we can get IRR. Okay. Do you understand? So the IRR is a little bit lower than the previous one. Okay. It's a little bit lower. Around 30%. Okay, any questions about this one? So any questions?
Doctor,
No, okay. So I hope
I
this
just
is
want
clear.
to ask one about the NWC,
Uh-huh.
the net working capital. So is it that there's a minus 2000, and then
2000 is the
at the
previous
end,
uh,
and then at the end of the you have to add back the 2000?
yeah. NWC. This one.
So if it's 5 year, then we put the 2000 at the 5th year.
Yes, not 3 years. 2000 is the 5 years. If extend to 5 years, you put the 2000 of 5 years. Okay.
Okay, thank you, doctor.
Okay. Okay. I hope it is clear. I think you have to do this tutorial lah. Okay. Before we stop. And for this one, I omit this one. Okay, I give you video later. You just read this one lah. The factor that affecting the product development. This one you can read lah. I don't think I will. I think so if you read in the what is it? In the textbook also possible. It's much clear lah. Okay. It's just a factor, social, company, government, right? There's a many other factors that affect your product development actually. Like what you have to provide for your product development, like a laboratory, right? Okay, and so on. Okay. And then they have another tutorial, this one. This one is just based on these questions. So please do the innovation map. Okay. This is I think so from the my textbook figure 110 to 24.3 and also and so on. So you can suggest. Okay, so please do tutorials 1. Okay, this tutorial 1, 2, 3. Okay, and 4. Okay, these 4 tutorials. So please submit. I give you. This is week 12, isn't it? By next week. I think you have a project also. Uh, this one by next week lah. Okay, Thursday. So the flow, I already explained you the flow how to calculate for the tutorial 1 until tutorial 3, right? And tutorial 4 is just based on the general knowledge you can do. So next week by Thursday lah, 13. Okay, please submit through e-learning.
Hello, Doctor.
Okay, yeah.
Shall we write it, the assignment? Is it okay if it was in Excel? Is it
Yeah.
okay if it was in Excel form?
For the assignment is okay for the Excel, but for the test, you have to rewrite. Okay, cannot copy from the Excel. Okay, exactly you copy, but you have to rewrite. Okay, handwriting for the test. But for the assignment, yeah, you can use the Excel. Okay, just
Yeah,
print out from the Excel.
another question. For the fixed value, it should be only the first year sales, right?
Hmm?
For the
What is it?
fixed value, like the last answer,
Mm-hmm.
should it be only the first year sale plus the advertisement?
I don't understand. Can
Uh,
you
could you go back to the last tutorial answer?
this tutorial? Okay.
The answer.
Oh, the answer. Okay. 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 Fixed cost. What is it? This one?
Yeah, should it be only the first year?
All year. This one. First year, second year, third year.
Yeah, but it's only 4,000, so it should be only the first year sales plus the advertisement costs.
Advertisement cost and fixed cost is from the what is it? The previous example is the same, right? This one, right? Advertising plus with the this one fixed cost 4 million, right? So for all years, first year, second year, third year is the same. You
Ah,
invest as the uh, for each year you invest the same value. Okay, fixed
ah,
cost not only advertising. There's a many type of fixed cost. Okay, not only the advertising. Okay, you have to check whether like wages. Wages is fixed cost or variable cost. Okay, what else?
okay.
Uh, what
That's
else? Huh?
good.
Fixed cost. If I check fixed cost such as manpower, is it fixed cost or not? Utility cost.
Oh, yeah.
Okay, this is not
Yeah.
only advertising fixed cost. Variable cost. What is variable? It's change. Sometimes it's change. Okay, it affect your what is it? Other cost, right? Like a transportation, is it fixed cost or variable cost?
Oh, yes, yes.
Office operation, sales and marketing,
Oh, okay.
treatment, QC and R&D. If you fix all the years throughout the years, meaning that your that value is the fixed cost. If the
Yeah, I
changes,
get confused
okay,
because I get confused because it's the same as the price.
variable cost.
Yeah, because it's the same number, so I
No,
get
no,
confused.
no. That one is only for what is it? That one is only for example one. Okay.
Yeah,
Later, if you add, for example, if you want to consider the what is it? The buy scenario, right? Year two is different, right? It changes. Maybe at year two or year three, you want to outsourcing your ingredients. So variable cost is going to be changed.
yeah,
Transportation is going to be changed, right?
yep.
Okay. Okay.
Okay. Thank you,
Okay.
Doctor.
Okay. Okay. So so that's all for today. Okay. So do not forget to submit your. Actually, we finished already. Okay, we finished already.